wherever it went. Here, I'll just open it up again. There we go. So I want to talk to you a little bit about inflation, some long-term strategies, some things that we're going to look at in the big picture. So a couple of things we're going to talk about. We will talk about crude here next and the impact that we could see there and the confirmation that we could see in the fact that we're not getting the lift there. Our preliminary University of Michigan inflation expectation is 4.8 and it came in at 4.8. So if we look at the inflation expectation, you can see we spiked and then we come back here. Understand that we are still dealing with inflation. The target, does anybody know what the target inflation rate is? What do we expect? What's the anticipated targeted inflation expectation? Good day, Secret Charlie. Secret Agent Charlie. Happy Friday to you, Rio. Good evening from Dubai. Hello. 3%, Christian. Exactly. And it was 2. They moved it to 2. And then they said, oh, well, it's a little bit high, so let's go back to 3, right? So at one point it was 2, correct, Carter. But it is 3 now because they got, got to move the goalposts when they can't meet their deadlines or their targets. And so they said it should be 3. Looking at this chart, let me just zoom out all the way through and highlight where 3 is. Highlight where 2 is, but highlight where 3 is. That's this line right through here. If we have 3%, target inflation is theoretically 2% inflation, 3% GDP is the sweet spot. If you can have 2% inflation and 3% GDP, you have a healthy, strong economy where you're growing faster than the rate of inflation. If you're obviously not doing that, that's a problem. If we have no growth and we have inflation, that's a bigger problem. And so they did move the goalposts. They said, well, we just want to get it to 3% because we went to 10. And even though the University of Michigan had it up at 7, we know we hit a lot higher than that in that move. So inflation back through here, even though the year over year was kind of in the 5%, we did hit a 10% inflation rate. So where we're at. Does this look disinflationary to anyone? Does this through here look like it's improved from here? And I just want you to see where those happened before. When did we see significantly high inflation above the 3% target rate? And what happened after those moments? We don't talk about the fact that we had a massive pullback in the market here. One moment, I am joking. And so when we're at this 3% rate, that would be excellent. We'd love it if we're there. So if we're looking at this, yeah, we could absolutely make inflation 2%. All we have to do is stop making money and even taking some in and using the bonds to sell bonds and pull money out of the market. So we can absolutely mess with the supply and change what we have as far as inflation and growth in the money, but it's just not there. So yeah, they went from 2% would be our great target. We went to 3%. They've held at 3%, but you'll notice that we only dipped down below that 3% for a minute. And when we're looking at this, this was the best time, right? 2015 to 2021 was some of the best inflation and the best growth. I'm verklempt. Talk amongst yourselves. So as we're looking at the 3% area, do you think we're anywhere close to it? Let me zoom back in so you can take a closer look at the inflation. We're going to look at the inflation. We're going to look at some trades and bonds, utilities, gold. We're going to structure all those here as we try to set up our charts. What do you think? Not even close. This to me, I mean, I think it's a little obvious when I'm zoomed. It's more obvious when I'm zoomed out that we hit these. Remember, we put, I don't know, $5.5 trillion into the markets here in 2020, and then it continued creating inflation. So when we corrected back down for that moment in time when we raised rates, we shot right back higher. And if we're going to be cutting rates, is there any chance that we're going to stay below the 5% rate? Does this really look positive or improving or lowering inflation? So if we're going to raise rates we could cut this. If we stopped printing, we could cut this. If we sold bonds and stopped printing and pulled money supply out, we could cut this. But we're not. We're cutting rates, and we're going to push this higher. Fish fillet Happy Meal, $50, right? And by the way, on the cusp of, how happy are we? And I know this is a survey, and I know as Don likes to talk, it's a bunch of University of Michigan students that are high, and it's a survey done by a bunch of college students that are smoking pot or something like that. I don't know. Maybe Don's listening. I don't know. He has a phrase and a terminology he likes to say. But as we're looking at this is consumer sentiment. As you look at this little chart here through here, look how sad we are. Look how unhappy we are. Look how depressed we are about the economy. Anything above 50 theoretically is positive, but that's not really true. You can see apparently this is not a percentile because we got to over 100% happy, over 100% consumer sentiment. As we zoom out, the worse that we have been, do you realize the sentiment from the long term? Look how depressed we were in 2008. During the deepest Great Recession, consumer sentiment dropped to 59%, then to 56. There we go, 56.6. And then when we started basing out in 2009 and started finding the base, we hit 56 again. Where are we at? We are below the Great Recession. We are below the Great Recession. And if you were doing technical analysis on this, if you did technical analysis on the consumer sentiment, and we're looking long term, what's the trend? You're fine. You're fine. You can joke, we can have fun. But the fact is, this is the sentiment is lower highs, lower lows, bearish trend, sad market. So don't think of 50 and above as positive. That's consumer confidence numbers. 50 and above is positive, 15 below is negative. This is not that case. This is simply saying we have some weird measurement that we can get past 102.4%. I'm saying that our consumer sentiment, however they do this, however they do the survey and how they measure this, is we are in a situation where we're less confident, that our sentiment is so negative as a consumer that we're lower than we were in the Great Recession. And inflation is higher, and inflation is up. If consumers are not confident, ask yourself this question. If you're not confident, what do you do? How do you spend? As we look at the GDP and we go back to growth, and we're going to tie it all to the charts here in moments. We'll look at gold. We'll look at all these scenarios. If you're looking at this in the sentiment, GDP, and I've brought this up before, but some of you may not have seen this. So we're going to say GDP is equal to, and we have consumer spending, we have business, I use I, spending, you have government spending, and you have net exports. Consumer spending is considered to be 60%. 60% of the so it used to be 65, 60% of GDP. Business spending has in the past been up here in the 25 to 30. And government spending used to be 15, now it's closer to 20%. And you might look at this and say, that doesn't add up. You're correct, it adds up to about 105, it's actually about 103. And that's because net exports is negative. And so I'd bring it down -5. So gross domestic, meaning internal, that's why you take out net exports, gross domestic product, most of it by leaps and bounds, even now is still consumer spending. And if we're depressed, if we're sad, if we have poor sentiment and bad forward-looking expectations, we spend less, we buy less. Rio says, retail therapy for depression. If we're consumer sentiment is low, we say, I'll just spend more money. And and we're looking at We're looking at the no fish sandwich is what John B is saying. Minu said there's no fish sandwich at the fish fillets for Friday. So no fish for you. No fish on Friday. That made me laugh. All right. So retail therapy for depression. So I'm actually chuckling because my sweetheart just brought me a toast. I got to show you if it'll let me show you. She brought me a toast that's an avocado toast with fried eggs, or not fried eggs. And if you can see, she made sriracha happy smiley face. So that's a way to make your day. Spicy avocado toast with hard-boiled eggs in the shape of a smiley face with sriracha. Sriracha, my favorite. All right, back to it. So what we have is see, my sentiment's all positive now. I'm ready to spend. I'm ready to go. I've got food waiting for me that has a smiley face and spicy, and I'm ready to go. So as we're looking at this, and we're looking at these, we're watching for the sentiment, the concept, the behaviors to hit the market. Economics, I like what we said in the past. I always say economics is not a hard science. You don't get to add economics and get a total. You don't get to say 5 + 5 = 10. You say consumer sentiment plus exports minus inflation plus growth minus plus. All that numbers, and it doesn't come up with any number. It's a soft science, but it is behavioral. So economics in the market in the world is behavioral science. So when we're looking at the behavioral science, when does this cause consumers to stop spending? And one of the things I'm watching very, very carefully is I'm watching for the default rates. They don't report very frequently, but that default rate is what I'm watching. Of course, it's homemade sourdough. Minu, I make it almost every week. All right. You have to do that. Have to. That's what makes it taste good. All right. So as we're looking at this, let's take a look at crude. Let's look at growth. Let's look at the market a little more closely, and we're going to find the next trade. We're going to find the next sentiment. And Rosario says that is how Professor Schiller won the Nobel Prize for economics. He won the Nobel Prize for having sourdough? That's amazing. All right. So crude is really stuck down here. Now, this is crude futures contracts. They're adjusted. They're Octobers. And we know, and if you've watched me at all, if you know what we've done, what we've looked for is I always say 65, 75, 65, 75, 65, 75, or 66, 76, but that range. But what we did is we broke through that back here August 5th. Now we tried for it again one time and we came right back down. So we're stuck between 61 and 65. This is an inflation indicator if there's demand. So I like crude and I like copper if we're going to measure whether there's demand or not, whether we have growth, whether consumers are spending money, whether we're going to take trips. If we are unconfident, if we have the sentiment that we're not going to see a bright future for us, as the consumer sentiment and consumer confidence has indicated, we're probably going to take less trips. We're probably going to drive less if we can help it. We're going to probably avoid spending the money, and the demand for crude steps down. So crude has been chopping all the way through here. And these intraday moves have been super, super flat. They move overnight and then they stop moving in the regular trading hours. But as we sit here, it's so flat, that's telling us that we really don't have the demand. Let me go to copper, and we're going to tie in the Chaikin that I talked to you about on Tuesday. Copper is slowly making higher highs and higher lows, but this unwinding, this is slow growth. This is slow growth. We've already unwound. We've already priced everything very low. Now this is the exact same channel. I'm just going to activate it and bring it down here and see if we can get out of this area. So if I grab the highs, the lows, even if we get up here, that 482 is kind of a barrier. If we break through 456, that is a problem for us. All right. So what we're going to do here, I know I was just teasing you, Rosario, talking about, since they were talking about a sourdough, and then you said that Professor Schiller won the Nobel Prize. I was just being not funny, I guess. All right. Yes. So as we're watching this, we're looking for the moves. What we're going to do is we're going to compare it to growth, and we're going to compare it to inflation. Inflation being the number one thing is GC. GC is our inflation indicator. When we have copper barely climbing off the lows and crude stuck below 65, I see this as stagflation. I see that as stagflation, like the behavioral economics, is still going to kick in. Think about, for those of you that were around in the 70s, meaning, I mean, many of us, most of us were around in the 70s, but those of us that were, I was too young. I was too young to be aware of what stagflation was doing. So if you would, all of you that were around in the 70s that were old enough to have financial responsibilities in the 70s, tell me how you felt consumer confidence, consumer sentiment during that stagflation time period. Because the current rising generations say, you bought a house for like 20 bucks. No, you bought a house for like 5,000 bucks, 25,000 by the late 70s or mid 70s. You could buy a house for 25,000. So they'd say, oh, that's amazing that you could have bought that. But what was the sentiment? How did you feel? What was going on with jobs? What was going on with your spending in the 1970s when we had stagflation? Let them eat cake, huh? No job, says Michael Young. Stress, says to Carter. Laurel says hangry, but that might be because we're talking about sourdough. Donut, says KKTC. Nothing like a 16% mortgage rate, 18% interest rates. Yeah, so when we're sitting in those situations where we have stagflation, we had to raise rates at some point. And that balance said, okay, we've got 18% mortgage rates, 20 some percent inflation with no growth. We had to control inflation and then try to find a way to create jobs. Brent bought his first house in there in 1979. There are no jobs. So as we're looking at this, I know that my in-laws early 70s bought their house for $27,000, $26,000, and he was making $5,000 a year. So his home was more than 5 times his annual income, which would be about what you'd see today, right? Average income now for the average income in the United States is about 65,000. And at 65,000, if you multiply that by 5, you're going to get about a 325,000, and you can get a 325,000 starter home. So really, inflation has stepped up roughly with what the jobs have been. It's a little bit skewed, but you're not paying 18% interest. But the stagflation, the gas lines, every third, yeah. So even if gas is cheap, if you can't afford it, it's not cheap, is it? Now, I'm not calling for the doom and gloom. I'm saying we're in a situation where sentiment is bad. We just revised all of the worst ever revision lower of jobs to show that we actually had 1 million jobs less. And I brought that up last year and I said, when are we going to see the revision to take the 1 million jobs out that we really didn't have? We apparently got it. So as we're watching this, we're looking at this, and I don't want to see us go into the 70s. I don't want to see us go into stagflation. So what we're going to do is we're going to look for where those trades are. The stocks that tend to do well, as you know, I love looking at Costco and Kroger and Walmart and just timing those trades. But as we're sitting here, I'm looking for the idea of when do we re-enter gold? Do we let gold pull back? Do we let it find us a lower low? Do we let silver find us a lower low? Because right now they're both at these high peaks. This is not a time I want to chase into silver and gold. I do like them from here, but I don't want to chase into it. I don't want to overspend. One of the things I keep hammering on is that the miners, XME, the miners are going to continue to climb. And I've been saying this for a month and a half. They're going to continue to climb as long as metals are near the highs. They don't even have to be at the highs. They can pull back, and our margins are still huge. The margins they're going to get, their quarterly performance, their earnings are going to be huge. So I want you to be watching for buying opportunities inside of metals and miners. But it doesn't mean we buy here. We might let it pull back. You could take a look at Nucor. Nucor is already in the pullback phase, and we'd be looking for an entry here. So let me walk you through Nucor. I want to get into bonds. I want to get into utilities. We have time. We've got about, yeah, we've got time. I got time. So as we're looking at this, what are we looking for? Blake, do you see gold running the way it did back then. I do. It's currently doing it, Maori. But one of the things you need to remember is 1980. And I don't think I can pull up the chart here to do reflect that, but and Medius had bought the first house when rates dropped to less than 9.5. Well, I built my first house and I thought I was robbing the bank at 7.5%. I loved it. Yukon Cornelius is always looking for silver and gold. It's thick as peanut butter. All right, so let's find Nucor and let's set up the trade. And let's strategize around Nucor. And the reason why I'm using Nucor is it's pulled back. Okay, that's the only reason why we're starting here. And then we'll find some other trades and we're going to do some setups here. Like I said, we got some time. We're going to do a few things today in the long-term perspective. So I'm going to pull up Nucor and we're going to look at the options on it. And the first thing we're going to do is look at what the implied volatility as a percentile compared to this last year. Higher highs, higher highs, higher highs. And as we look right through here, 13%. And that 13% number is low. Theoretically, I want to be a seller of premium or a buyer of premium, not a seller of premium. But what we want to talk about, and this is what I brought up yesterday. If you didn't get a chance to watch yesterday's discussion of selling implied volatility and buying implied volatility, we can still structure this in a way that said, I don't need it to go higher. I need it to have a flat market, an up market. I can neutralize my delta while still benefiting if I can find the right options. Now, October 17th is 33.59, and September, we can go to 33.96, but I don't think I want to do that. I think we're going to turn this into a diagonal. We already know it's inexpensive. So if I buy October, this is what I was talking about yesterday. And what we're going to look at is buying, okay, I was looking at the wrong line. We're going to buy a delta near 70 at 135. And our implied volatility is 32. I would like to sell more than 32 on the side I sell. But I'd like to get paid enough premium if I can that in the next 35 days that I get overpaid the extrinsic value. So even though if we're going to pick different time frames, I'm adding one layer into what we discussed yesterday. So I'm going to buy the 135. I'm going to pay $10 for it, 980 by 1010. So we're just going to write $10 up here. And of that $10, about 3 of it is extrinsic value. You see what we're doing here? The time decay that we're going to lose in 35 days is about $3. So not that much. For 35 days, it's not that much. As we look at this, we're going to go into, let's just take a shorter time period, and we're going to go even bigger time period because I don't think we're anywhere out of the woods here. So we're going to go with 2 weeks. So we're going to go 2 weeks versus 5 weeks is really what we're doing. If I sold out of the money and I sold a delta between 30 and 40, and I can collect a higher implied volatility, 33, 33, 44, that'll work for us. Now look what happens. I'm going to erase this so we can look. Erase, erase, erase. This side we bought was $10 and $3 of extrinsic value. This side we're selling a delta between 30 and 40. And we can go for this 33, 36, the higher implied volatility. They're going to pay me $2.10 to $2.20. If I'm getting paid $2.20 in 2 weeks, how much am I going to get paid if I roll it if nothing changes? If it stays here flat, in 2 weeks, I should be able to roll this or sell it again for another $2.20. Can I get all of my extrinsic value? All my time decay is going to be more than compensated. What this does is it turns my, excuse me, my long call, even though the implied volatility is low, into a covered, a long call that has no time decay at all. It gives me a delta of 70 for the long term, and it gives me a delta of 35 here. So I'm going to be in a net delta of 35. I'm still benefiting 35 cents per dollar move, but my cost of my trade is all the way down at 780. Yep, and I've lowered my cost basis. I've lowered the expectation. Didn't pay $10 or $10. I'm going to pay $7.80. And if nothing moves, then I'm going to do it again, and I'm going to collect another $2.20. And if nothing moves, I have one more week. So theoretically, I should be able to get $1.10 out of that, and I'm going to get, in the end, $5.50 out of just selling the exact same strike if nothing moves. If it moves, we can actually do even better. But if I get $5.50, my total cost now is at $4.50 for the long call. And if it doesn't move, it's going to be worth more than $4.50 anyway, because I bought a delta near 70. So this eliminates the time decay, allows us to be in the trade and treat it, like I said before, a synthetic covered call. If we go back to that level again, we're talking about 135 versus 145. So if by the time we're done, I have a cost basis of $5.50 and I have a $10 wide spread, I have no risk really on that trade. If I'm at 135 versus 145, and we're currently at 141, I'm going to be in the money. I'm going to have collected more money than time decay, which means I have a position that is worth more than break even, and I have no time decay left. Now, like I said, I'd like to do this for a longer time period on metals and miners because we are dealing with a longer term view. So if we go out further, normally we'd expect to see this always going higher and higher and higher and higher in the future. The further out we go, the less likely, or the more risk we take, the less we know what's going to happen. But I want you to notice that it just dropped down. Current IV ranking is 1%. I want to be a buyer. If we go even further out, if you say they're going to cut rates, that's going to create more inflation. We could cut 3 by December. December's 33. That's not higher implied volatility. I should be able to buy out here in December. It's going to cost me more, but watch what happens now. If I buy the 135, same strike. I like to buy the closest to 70, but 66 can work for us. We'll use the same strike. I have to pay $14.50, but now I have all the way out to December. I have 98 days. So $14.50, and now we go back here and we can say, okay, I'm paying for a 34.63. I'm getting how much time decay? 737, but I have almost 100 days. Now, to make this easier for us, we're going to go here, and we'll do October, November, and December. So we're going to have 3 rolls at that level. And I need to write it down so we can see. I already clicked on it, so we have it saved. But this one, we're going to say, to make my math easier, we're going to say $14.50. I'm going to overpay for it because we'd try to split that, but $14.50 for the 135. Time decay is 735. The extrinsic time decay is 735. Now we're going to do month to month to month. Okay, so we're going to do October, November, and December. They're roughly 30 days each, 35, 35, and then 28. So roughly 30 days. So we'll just treat it the same as if it were each one was the same. If we look at October and we sold the delta near 30 to 40, undo, restore. I'm trying to set up a long-term trade for you here. If we sell the delta to between 30 and 40 for a month, since we're buying out to December, we have October, November, December, because December will have a selling as well. And if we're looking at a delta between 30 and 40, well, I'd have the 150, it's even higher. So if we go to the 150, they're going to pay me 260. If I have October, November, December, I barely pay for my time decay, but I also have a $5 bigger target. I think you could get away with this one and sell at the money. So if it gets up to that 145, then we'll roll up and out. We'll up and out to get more premium and to get a better return. But if you want to go with the at the money, you're buying in the money and you're going to sell this slightly higher, 250 higher, and you're going to get $4.30. So this is going to work for me, frankly, the 260. because that's going to still pay for your time decay, and it's going to give you a 135 by 150 trade. So it pays for all of your time decay. You end up having a cost basis by the last month that is going to be roughly $7.15 on a $15 wide spread. So you have a potential to have no time decay and the potential to make 100% return on your risk. And all they have to do is not go lower. And if we want to, we always have the choice to get assigned or exercise our option. You really don't have a lot of reason to do that in option trading. So we just say, yeah, let's not worry about the 1.5%. But some of them will give you higher returns. That'll be interesting. Overall, we have the potential to make 100% return on risk and have no time decay. And this is a diagonal. Different strategy, different idea. I'm not looking for one single move. I'm looking for a trend. So it's a variation on it. It is a diagonal trade. And we're looking at this to stay bullish and potentially just get back up to these highs. That's all I'm looking for. But it could go higher and higher and higher. And every time we get close to that strike, if we move it out, move it out, move it out, move it out, every month that we roll, we move to the next delta between 30 and 40. We're still going to get paid that same $263 in premium, but it's going to move our target further out and give us more gains as we push it to those higher levels. I have a threshold on the IB of really, I go 35 and below. I want to be a net buyer. For sure, I want to be a net buyer. 35 to 50 is, I need to run the numbers. It can go either way for me. Anything above 50, I just need to be a seller, period. But I use 35 to 50, and 50 and above. So 35 to 50 could go either way for me. 35 and below, I want to be a net buyer. Does this make sense? We okay with this? I've got 30 minutes to go through a few other trades. This is the one I like. I like this setup here on Nucor, and primarily because it's pulled back. I mean, if you want to look at the same thing on Newmont, it's very high priced. I don't want to buy into that at the peak. Same thing with when we were looking at things like FCX. Oh, FCX pulled back a little bit better. I thought we were bouncing, and I didn't look at FCX today. FCX could be a trade too. We could run the numbers really, really fast here. I'm not going to take a lot of time here, but we're going to do the same idea. Just so you understand the logic that we'd set up here is if I'm looking for bullish in metals and mining because I expect inflation to hold up, but not necessarily growth, they make their margin, same roughly 1.36%. I'm going to scroll down really fast and say current percentile 3. I want to be a net buyer. If I'm going to be a net buyer, we'll still use the December because I think we could get those 2 cuts, 3 cuts by December. I'm going to do the exact same structure. I like to buy a delta near 70. So we're going to go there. We're going to go 41. 41 on FCX is going to cost me $5.20. It's going to cost me $2.17 of extrinsic value. Okay. Now, month to month, we'll speed this up. I'm going to go with October 17th. And if I look at October 17th and ask the same question, can I sell a delta between 30 and 40 and get paid enough to pay for all my time decay while I wait for this trend to last to December? And if I'm right about the trend, or even if it just sits sideways, I will bring myself to the point where I am safe. If I'm looking at this, I could sell the 46, get a 37, and that's going to give me $1.14 per month. So $1.14, $1.14, $1.14. Whoops. And so that's going to cost us pay us, not cost us, but pay us approximately 352, 342, and more than pay for our extrinsic value. If everything stays flat, I should be able to sell this and collect my $1.14, $1.14, $1.14. It's going to pay me 342. It's going to bring my cost basis down. And my cost basis is going to be roughly $1.58. Did I do my math right on that? $1.58 at 41, which means my break even would be 42.58, and we're currently at 43.96. If it goes up and hits my target, and I didn't get it rolled out, well, I'm 41 to 46, and my cost basis is $1.58. That one is going to give you 200% return on risk. Number one thing I'm looking for is I want to get this paid for in about 2/3 of the time or less, Andrew. I want my time decay to get paid for. I want my, so that'll push my position into positive territory, even if it doesn't move. That's kind of my guideline. And on 3 months, generally speaking, you should be able to do it in 2. So that's kind of the idea. Or 3 expirations, like even if you did 3 weeks, you should be able to get it paid for in 2, all your time decay. Now that still leaves you with the directional bias, because we want a directional bias here. These are not the calendars that we talked about before. This is playing for the directional move. It's saying, I think this is going to continue to go higher. Now that tells me that we're looking for that to go higher. Like I said, we could do the same thing with Costco, Kroger, and Walmart. We're in a position where Costco, if we're going to be in a stagflation scenario, this is the same kind of chart that I would look for. Costco's an expensive stock. It's $962. If I were just to trade this, it's going to cost me a lot of money, right? Costco is going to cost me a lot of money to trade the same strategy, but it's going to be a lot less to trade the strategy that I'm sharing with you today than it is to trade the stock. So if we were to look at this and do the same thing, I'm not saying this is going to price out, but look, 25 percentile, so I probably want to be a net buyer. This is going to set us up so we should be able to do a December contract, and a delta near 70 is 80 bucks. So that's $8,000. Now that seems really, really, really expensive, but remember, $36 of it is time decay. If we look at the front month, and again, we have to have the assumption that we're going to be flat to up. If we look at the front month and sell a delta between 30 and 40, 42 is as high as I will go, and the implied volatility is 24 there. That could work. So if I go with the 985, that's going to give me a net cost of 57.90. It's going to bring my cost down. See that? I'm over half in 1 month. That's what I'm looking for. So in 2 months, I will have collected $42 roughly versus my 35. That'll leave us in a profitable situation. Now, again, this is expensive, $5,790 for one contract. But when I roll again, what happens to my cost basis? I go from 5,790 to 3,790, and then in one more trade, I've got this trade almost paid for. 1,790, and I'd be pretty safe. Now, I think your easier one is going to be Walmart or Kroger, because your costs are going to work a little bit better for you as far as the cost of the trade. $68. Again, we don't need it to go up. We have to have it not go down, and this will pay. We've got a bullish divergence on this. Kroger is bouncing up with a bullish divergence out of its oversold zone post earnings. And so this could be a very positive one as well. We're post earnings. Let's do the same one really fast again. And there is no December. So we're gonna have to go out to January on Kroger. And January is 65 and 280. Now we'll always have a month. So that will always be the case. We'll always have the next month. So as we get close to the expiration of October, we will have a November. But if I'm going to do this and I have Kroger's 660. Let me just write this down. I need to hurry so I can get to bonds and utilities here. 660, 285 is time decay at $65 strike. So what are we looking at here? Delta between 30 and 40 is 70. It's $1.29. Is that at least, I mean, quick view, is my extrinsic value at 40 at least half of my time decay? Yes. Am I getting 3 time decays or more? Yes. I'm actually getting 4 here. So if I get 4, $1.28, I'll even round it down. Well, it's now $1.30. $1.30 times 4. 520. If I play this all the way out to January and it doesn't move, I get $5.20 on a 660. That leaves my cost basis $1.40, and my spread is 65 by 70. They are directional. Diagonals are directional, up or down. Yep. And the reason why they're diagonals is because, let me just walk through this really fast as well, and then we'll do utilities next. This is the idea. A vertical, you have October, November, December. You have 70, you have 65. If you are long the 65 and short the 70, see, it is vertical. It's straight up and down. If you are buying, like I'm proposing right here, a different time and selling here, that is a diagonal. See, the expiration versus strikes. Same expiration, different strikes, vertical. That's why they call them a vertical. Different strikes, different expirations. It's a diagonal. It's a diagonal line. So theoretically, we should call calendars horizontals, but they are time only, so they call them calendars. So yes, this is a diagonal. The diagonal has a, remember, I'm buying a delta of 70. So I'm long 70 delta for 4 months or 3 months, and I'm short a delta of, say, 40. My net difference is a 30 delta. So I am directional on these, not like the calendars. These do cost more because it's the cost of the trade, period. Cost of the trade, the initial trade is the cost of the trade. Yeah, calendar if you don't expect any movement. Let's go over to the utilities really quickly, and I want to measure this out and kind of set up this from the big picture utilities. Utilities have pulled back aggressively. If we are going to see this as an opportunity for going back into safety, we would be looking for a pullback and a bounce. Utilities gave us that 3 days ago. Bounced out of the oversold, crossed back up, crossed the moving average, gave us a bullish divergence, and we should have been stepping in probably in this day. And so utilities are breaking out. I think this is another situation where we've recovered off the lows, and now I don't need to time it. It's fine. This is the place. And I would have rather had you buying in here because you would have made a lot more money. But even now, as we look at the utilities, any surprises here to see low implied volatility on an ETF? That's perfect. We may want to get assigned on these, but for now, I can still do the same structure and say, let's go with December. I'm going to go with December. I'm going to buy the delta of 70. That's 82. That is $1.80, 82 strike, 5, 10, and 180 of time decay. That's December. What's October? We'll have October, November, December. So we'll have 3 months of this and a delta of 40, 30 to 40. That's going to give us 87 and 75 cents. 75 cents times 3 is 225 versus my extrinsic value of 180. It's going to put me in a positive time decay situation, even though I'm going to be at the very last in a long vertical. And that long vertical, if I'm where I'm at right now, then I'm going to be in an 82 by 87, so $5 wide spread. I'm going to reduce my costs by 215 against my 510. It's going to leave me with $2.95. Not quite 2 to 1, but it's still doable. Now I think you're going to get better ones if you do the utility specifics like SRE, Dominion, Duke, etc. But let's go to bonds and let's do the IEF. Don's putting some Walmart on. Hey, that was my trade. No. So Walmart, like I said, I like Kroger, I like Walmart, I like, and see, I convinced Don, even Don, Kroger, Costco, Walmart, long, utilities, long, metals and miners, long. And here we go. We'll slow it down here as we do our last ones. We got 15 minutes. So IEF, I've been waiting for this to pull back. I missed it when it stopped us out. It absolutely stopped us out in deep currents. Deep currents, we got stopped out here on the gap down, went right past our stop, and then reversed right back in. I said, this is not the time to get out. We want to stay in. And we would have stayed in, but it went so fast, I didn't want that. So now we're breathing out. I'm waiting for this to breathe out closer to 96, retest the previous highs and the channel lows. I would like to buy at 96, but here's the thing. We can kind of have our cake and eat it too. Even if it falls down to 96, what's the risk and exposure? If I trade the same strategy, even now on IEF, I'd prefer to do it low when we're closer to 96. But even now, if I look out, we're going to determine whether this is a reasonable trade. We do probably want that yield at some point. And so we may want to just do this as a covered call strategy. But right now, let's set it up as the same strategy, the same concept that we're looking at. Notice the implied volatility, nearly 0. I mean, 7. It's pretty low. 5% implied volatility rank. We'll do the same December. We're going to look for that delta near 70. I've got a 71 at 95, and we're going to do the same math. IEF, 95 strike, 265 is the price. And what was the extrinsic value? 75 cents. So let's take a look at the front month. If you're bullish, if you're directional in these, if you're neutral, yes, go to calendars. But at this point, as we're looking at this, delta between 30 and 40, the delta between 30 and 40 is this one. Ooh, this one's outside, this one's outside. So I really don't even have one to work with. Tough call. Let's go for a lower probability of getting called away so we can stay in the position. And so you see I'm outside of the 30 to 40. We'll go with the 29 at 98. Not ideal, but 33 cents times 3, 99 cents. Cost basis goes down to 166. We more than pay for our time decay, but we don't pay for it in the second month. That's my goal, always to see if we can pay it for it in the second month. This one's not pricing as well. So we might need to wait for it to pull back anyway. So if we can get it, even then, is it worth $1.60 to $3 spread? Yeah, it could be. It's reasonable. It's close. But as it sits here, I would like it to pull back further. I really want to have it paid for in 2 out of 3 months. So the last one's a bonus. Will the rate cuts affect 7 to 10-year bonds? They're going to affect those a little bit quicker, faster in the shorter term versus the 7 to 10 years. It'll impact these more than it will impact the 20 to 30 years. It'll impact even more. The shorter time frame you go, the more it'll impact it. And if we're going to cut rates, the market will raise prices on existing bonds because they have a higher rate. And so the current existing bonds are going to have higher demand, and it's going to drive prices up. And so the price goes up, generally speaking, when you cut rates. Now, we've already priced it in a little bit, and we've already seen that movement. So having it pull back is a good thing for us. IEI will have a little bit higher impact, but you see there's no options really to work with here. I mean, you could go out to January at 119 and do October, November, December, January and go 4 months. But there's just not much to work with here. And see, I don't have a 30 to 40 here either. So probably not worth doing on IEI, but IEF would work for me. But like I said, I would like it to pull back a little bit further. The price is a little bit better as we get into these lower levels, and we'll do the same thing. When it's time to replace the short, do you readjust the long back to a 70 delta? You leave it alone, Ronzi, unless, and this is a little side note that I'm not gonna have a ton of time. I'm not gonna have a ton of time to talk about this, but I'm gonna show you from a high level really quick, okay? Don, you're just jealous. All right, let me show you what we do. And I'm going to go all the way out to that December contract. This is what I do. And then we don't have the numbers, but you'll see what I'm getting at. If you buy a delta of 70 and you don't move, this is going to stay roughly a delta of 70. If you move up and up and up, my rule is buy a delta of 70. When price goes up and your delta closes the day above 85, then you roll it back to a 70. Now, what happens generally if you close the day above an 85? If you buy a delta of 70 and close above 85, in most cases, your option will have doubled, which means you can roll it down and back to the 70 delta and pay for the original trade. It's never, I hate the idea that you have a free trade. It's not true. It's never true. What it does is guarantee that you don't lose your original principal. What it does mean is you're still risking your premium. If you don't close the trade, you're still risking profits and your original premium. But what this does is it locks it down so your original principal doesn't lose. So anytime you go from a 70 delta to above 85, close the day above 85, you can roll it back down to a delta of 70. And in most cases, you will completely pay for the long trade. It should be roughly 2 times what you originally paid by the time you get there. Then you're still collecting the short premium and your original premium is protected. So no matter what. But the other thing is you're also moving your short deltas going up. Your strikes are going higher and higher as well. If the trade goes down, I always go off of the chart and say, if this goes, I know today's not the day to buy, like I said, but if this closes below here, if I buy near 96 and it closes below there, then get out. And that's usually right in the 40 to 50. Tony's is all long and luxurious. See, I did not wear facial hair all the time when I'd travel. When I traveled with Don, he was used to seeing me clean shaven. He had 15 years of any time I'd be traveling with the thinkorswim team. All right. Yeah, so the delta becomes 50 and 60, and generally speaking, your position has lost the money. And remember, if it goes to add the money, that's your highest extrinsic value. But if you've already paid for the extrinsic value, then you've also reduced your cost as well by about 20%. So have a line in the sand, a barrier. I don't roll it back down to a 70. If it's falling against you, you do not roll into more risk. Do not roll into more risk. Not on those. All right. So we talked about IEF, we talked about XLE, we talked about Kroger, we talked about consumer staples, at least Kroger, Costco, and Walmart. We ran numbers on Kroger, Costco, but what else are we paying attention to? You'll notice we're kind of getting a real mixed story. We have communications, which is usually growth, consumer discretionary, which is usually growth up here at the top, but we have crude up and we have utilities up. Those generally don't run together. Crude and utilities generally don't run up together, and yet there they are. And so they're running up together, and then the weakest down here is basic material and healthcare. So we have some defensive sectors up at the top, some defensive sectors at the bottom. So if we go back to look at the big picture and go back to the SPY, we've already talked about utilities and bonds. As we look at the SPY, is this the top? Always the question. I'm going back to what we talked about. Thank you, Kosher. I'm going to what we talked about on Tuesday, and going to combine all these stories. What do we have? We have the higher highs, upward channel up through here. We have an overextended line here. And if it trades back inside 2 standard deviations, that's an indication that we need to probably get out of long positions and go short. We are highly overextended as far as the volume compared to the price action and accumulation. So we've accumulated pretty fast. And when we see it, this is what we're looking for. When we see this happen, we don't immediately go short. We say, okay, you've gone too far. When are you breathing out? When does it cross back inside 2 standard deviations? So when we go through here and we get all the way up to the top, when we trade back inside, that's your sign right there. So we're all the way up through here. If you see a sell-off, even if you don't sell off much, if you see the 2 standard deviations on my modified money flow, get back inside there, probably time to walk away from the broad market and the growth market. Tied all the way back to consumer sentiment, that would also be seen in things like communications, technology, and others. Notice what technology did. We traded up. Don't worry about this for just a second. We're just worried about price. We traded up and up and up. And when did we see profit taking? With volume right here. So we had a gap up, close down inside of tech. Gap up, close down, which I call is called an exhaustion gap, showing you that this does not have the wherewithal to maintain. And it is the exact same candle that we traded back inside 2 standard deviations. That's my warning of the top. That's why I'm looking for back into Costco, back into Kroger, back. I still like financials, Costco, Kroger, Walmart, FCX, Nucor, Newmont, the metals and miners. They can stay up and climb higher even if we don't have growth in gold and silver because they have margins. These are overextended, and we're seeing the first break down up here. And we can go back and look at history and say what happened before. Traded up, traded down, pulled back. Okay, traded up, traded down. Oh, did not pull back. In fact, it went back up and to give us one more right here. So this gap up close down was in the 2 standard deviations, out of the 2 standard deviations, and gave you a warning. And gave you the warning here. We tried one more time, and then down it went. So that 2 standard deviations is not always going to call the top and the pullback, but it does tell you when you're reaching an overextended time frame. All right. Questions? We've got 2 minutes, 3 minutes before I will pass the baton. Let me know. We'll wrap it up here momentarily. We're going to be passing the ball. Gianni is going to come in a minute and take over. Blake, will you be posting a DC trade today? I'm trying to, but EF has not pulled back far enough, so I think we'll probably look for that utility trade or the new core trade. Doug, it's not pulled back far enough or discounted enough for us to take in the deep currents. Yeah, I think you could do XLK with puts. I would probably do a calendar if you're going to get paid the premium and give yourself the target to fill that gap. I like 265. 265 for a calendar could be really good. Could happen pretty quick. Yeah, so Doug, I don't like IEF's position, and the premium isn't tied well. So we're probably going to have to look back to that XLU. And like I said, this one still prices and premiums are looking pretty good there. We'll be looking at something probably more like Dominion that we could even consider putting in the position. How long will I think the uptrend will last, Cal Tours, and which one? In utilities or the current uptrend in tech? That's your first warning that we're already probably topped out. S&P, you could continue moving a little bit higher. I'm not sure which one you're looking for. I'm just waiting for you type which one you're talking about. You're talking about the trend in here. I need this to trade back outside the 2 standard deviations, and it might go up and tag 663, 664 before it does. I'm just waiting to see that the volume gives up, and today's the day. Look, we're more than halfway through the day. We should absolutely be seeing higher volume on a breakout to 52-week highs. We should be well past halfway of the volume. We should be about 60% of the volume for this point in the day. And what are we at? We're at 24 million when our average is 67 million. So by the end of the day, we're going to probably be about 35 million, which means we're going to be trading half average volume on the 52-week breakout. That's a warning to me as well. So it could be now. This could be the top of the broad market. And if it is the top of the broad market, I will expect to see some profit taking, and the profit taking will bring my modified money flow back inside 2 standard deviations. We're going to see that XLK follow through to the gap down close down, and the gap down close down, or gap up close down, excuse me, the exhaustion gap needs to get through here. And this gap up close down needs to get through here, needs to close below 271. So if we close below 270, I think you have a pretty decent target of 265. And whether this can maintain, this is what you'd see as a setup for an island reversal. And this is indication that volume-wise, we're profit taking. So could be now. It's today. Gianni's bullishness is dead on technology today. No, I'm just kidding. Never could break Gianni's.
You cannot break my resolve.
You cannot break his happiness, his joy, and his love of bullish markets.
No. It's very fun.
Yeah, 52-week breakouts on 1/3 of the average volume. That's got to be sustainable.
They're waiting for the rate cuts next week. They can borrow on margin at cheaper rates.
By a whole 0.25, that'll make a difference.
Yeah, if you got $100 million, it might.
All right. Well, Gianni, I'm going to make sure you are the host before. Oh, you are. You are the
Oh,
host. Before I
great.
jump off, you can share whenever you're ready. I will
Okay.
hit stop share. I will write up my article and answer some emails, but I will wish you a happy weekend.
Have a great weekend, Blake. Thank you.
And we'll let you talk about this sloped September. Wow, what's that
Well,
about? It's garbage day, that's for sure.